Hello, welcome to Rad Academy. It's very nice to have you on my channel. So, today we are going to talk about production costing techniques. Production costing techniques. We are going to solve one question on production costing techniques. And in this particular video, I'm going to take my time to explain it very well for you to understand. So, before we go to the question, I'd like to explain what you need to know anytime you come across a production costing techniques. So production costing techniques, the production costing techniques, we have the marginal costing technique and we have the absorption costing techniques. So what we want to know here is to find the net profit. So it's very easy. It's just like finding your net profit as we did in financial accounting, preparing income statement or trading profit and loss account for the year ended to get our net profit. It is the same thing here, but here we are using the marginal costing technique and the absorption costing technique. Very simple. So the first step, anytime you come across a production costing technique, after reading your question and going through all the question and understand it, the first thing that should come into your mind is to find or is to calculate the production cost per unit for the marginal costing and the absorption costing. Both techniques. That is the first thing that should come to your mind. You calculate the production cost per unit. So when calculating the production costing, sorry, when calculating the production cost per unit for both technique, one thing that you should know is under the marginal costing, it entails or it involves only the variable cost. Only the variable cost. And the variable cost is the direct material, the direct labor, or the direct wage, and any direct expenses in the question. So in some questions, they'll just give you straight the variable cost is this. But then in some questions, they don't give you the variable cost is this. What they do is they'll give you the direct material, they'll give you the direct expenses, and they'll give you the direct labor or the direct wage. So it is up to you to add these direct expenses or direct cost to get the variable cost. So with the marginal costing, the production costing techniques is only the variable cost. Then when you come to the absorption costing to find the production cost per unit under the absorption costing, it is both the variable cost and the fixed cost. So you find the variable cost per unit and you find the fixed cost per unit and you add these two to get the production cost per unit under the absorption costing. So all what I want to say is under the absorption costing, it is both variable cost and the fixed cost. And under the marginal cost, it is only the variable cost. Very simple. That is it. So after getting your production cost per unit for both techniques, now you come and prepare your income statement for the year ended. Oh, so it is the same thing as income statement we did in financial accounting, where you bring your sales, you less your cost of sales. So cost of sales, you read the question and there is opening stock. You bring your opening stock, you add your production. So here it is production. It is not purchases. It is production. So they'll give you production units and the production cost per unit that you multiply, you've calculated for. You use it to multiply the production units given to you in the question. So you add to your opening stock. If there is no opening stock, that is fine. Then you add, you get your cost of sales. So you get your cost of goods available for sale. If there is closing inventory. Then you less your closing inventory from your cost of goods available for sale to get your cost of sales. So under the marginal costing, and after getting your cost of sales, you add variable expenses. You add what? Variable expenses like variable selling and distribution expenses, like administrative expenses. Those are non-production expenses. You add them to the cost of sales. So when you add this to the cost of sales, you now less the total from the sales that you've calculated up there to get. So the difference will give you what? Contribution. Then after getting your contribution, you come and less the fixed production cost and any fixed expenses given to you in the question. So then you come and less to get your what? Your net profit. Very, very easy. So one thing that you should know is under the marginal costing, the fixed production cost is treated as a period cost. And under the absorption costing, it is treated as what? A product cost. So that is why we add the fixed cost per unit um, to the variable cost under the absorption costing. We treat it as what? A product cost. So when we are lessing fixed expenses, we don't, and when we are lessing fixed expenses under the absorption costing, we don't come back again to less the fixed cost again because it has already been fixed inside the product cost. I hope that is clear. So that is just a format work. So all what you need to know is just understand what it is and get the format. It's just a format work. For me, I believe anything that is about format and formulas is very, very easy. Just get the format or just get the formula and you're good to go. You score all. So that is all about production costing techniques. Very, very easy. So now I'm going to take you through the question. So I read the question. It said, ABBA Limited uses standard costing system. The standard cost per unit of a product B-Smart is as follows. It's a direct material 5 kg at 1 cedis per kg is 5 cedis. Direct labor 4 hours at 0.6 cedis per hour is 2 cedis 40 pesos. Production overhead variable. The question has specified that it is what? Variable. So that one too is 1 cedi 20 pesos. And he said what? Fixed. So with the production overhead, we have variable and we have what? We have fixed. So he said fixed is what? 1 cedi. And he said the standard production cost is 9 cedis, 9 cedi 60 pesos. And he said standard selling price is what? 15 cedis. Said. Now you continue to say the standard fixed production overhead absorption rate was based on a budgeted activity of 100,000 units. During the period 3, productions was 100,000 units as planned, but sales were only 81,000 units. Budgeted fixed production overhead was 12,000 less than the actual overhead. All units were sold at 15 cedis per unit. There was no opening stock at the beginning of the period other than other costs incurred during the period were in relation to selling and distribution. These were as follows. Item of expenditure, variable and fixed. So he said selling and distribution, the variable is 10% of sales, and he said fixed is what? 112,600. And when you come to administration, he said there is no variable, but then fixed it is 110,000. You are required to prepare I income statement for period 3 using two main costing techniques. So that is, if you don't know that the techniques are marginal costing and absorption costing, you'll be sitting there. Then II is what? Reconciliation for the two income statements. So the requirement that has been given to you is just a format work. With the II, the reconciliation for two income statements, and that one is also a format work. I'll take you through. So before I continue, I want to talk about the under absorption and over absorption because I've seen that here. So with the under absorption of fixed overhead, under absorption of fixed overhead, and over absorption of fixed overhead, this fixed overhead absorption or under absorption of the overhead, it comes only under the absorption costing. There is no under or over absorption under the marginal costing. There is nothing like that there. Please note that it is under the absorption costing where you find over or under absorption of fixed cost. Okay, let me explain where we get the under absorption or over absorption. So when you read this question carefully, he said the budgeted fixed production overhead was 12,000 less than the actual fixed overhead, which means the actual fixed overhead is what the question is saying is the budgeted fixed overhead is 12,000 less than the actual, which means that there was under absorption, which means that there was what? Under absorption, which means when we were budgeting for the fixed overhead, we under absorbed the fixed overhead, and we don't have to under absorb or what over absorb it. The budgeted and the actual has to be what? Has to be the same. So during the budgeting, we under absorbed. So now they are saying the 12,000 is lesser than the actual, but then it has to be equal for us to get the right cost. Do you get it? So now that the budgeted is 12,000 less than the actual, then it means we under absorbed the fixed overhead. Then it means if it was under absorbed, then we have to add back so that it becomes equal with the actual. I hope you get this part. So in this question, they've already made they've already given you the amount already. They've already given you the amount, and you don't need to calculate for anything. All what you need to know is since the budgeted is less than the actual, then it is what? Under absorption. So when you get to the absorption costing, what you are going to do is we are going to add back this 12,000. So you don't worry. Let me take my time and explain the marginal costing to you. Then when we get to the absorption costing, we'll cross that one too. So first of all, the first thing that you have to do is to find your production cost per unit. So let's do that. So calculation of production cost per unit. Sorry if the video is very long. I just want to. So we have MC here and we have AC here. So we have we have the variable costs. So when you look at the question, the variable cost, we have the direct material, we have the direct material, and write DM so that it's, then let's put our CD signs here. Let's put our CD signs here. So we have our direct material, which is what? 5. Is under the AC2, it is what? 5. Then we have our direct wage, which is 2.4. All these figures were given to us in the question, 2.4. Then we have our variable overhead. We have our variable overhead, which is also 1.2. Then we have our what? So now let's come to our fixed overhead. Our fixed overhead. Let's come to our fixed overhead. So I said under the marginal costing, we don't treat fixed overhead over there. So we put a dash there. Then when we come to absorption costing, I said that at the absorption costing, we treat the fixed overhead. So in the question, the fixed overhead per unit is what? 1. So now we add, when we add all these three, we have 8.60. Then here we have 9.60. So that is it. After doing this, you are done calculating for your production cost per unit, for the marginal costing and the absorption costing. Very, very easy. Now let's move to preparing our income statement. So we are going to prepare our income statement. Income statement for period 3 using the marginal costing technique. So that is it. So income statement. Income statement, I believe if you're an accounting student or you've done accounting before, you've done income statement before. It is the same trading profit and loss account that we did in financial accounting. So we bring our CD sign. We bring our CD sign also here as well. So for income statement, we all know that we start with our what? We start with our sales. So let's go back to the question. The question said, but sales were only 81 units. So the sales unit is what? 81,000. So 81,000. Then they said the standard selling price is what? 15 cedis. And here again, they said all units were sold at 15 cedis per unit. So we multiply the units by the price per unit. And we will have 1,215,000. We don't have any returning words here. So we come to less cost of sales. So now we are going to find our cost of sales. In this question, they said there is no opening stock. So if there is no opening stock, then we start with our what? Production. That is the marginal cost of what? Production. Marginal cost of production. Now we go to the question and we find our production unit. What is our production unit? Our production unit is 100,000. That is what the question said. 100,000. So 100,000 by what? The production cost per unit. And when we calculate for our production cost per unit, so this one is under marginal costing. When we calculated for our production cost per unit, we had what? 8.6. This one is production cost per unit. So we multiply the production units by 8.6. So when you multiply this, you get 860,000. Let me write my 860,000. Then when you get to this point, this since there is no this opening stock, the 860,000 is still your cost of goods available for sale, which is the COGAS. So after having your cost of goods available for sale, when you read the question carefully, you see in this question, the question did not tell you the closing unit or the closing unit is this amount. But then you should know that they said they produced 100,000 goods and they were able to sell only 81,000. It means they were not able to sell all the 100,000 goods that or 100,000 units that was produced. So it means that there is what? Closing inventory. Since they were not able to sell all the 100,000 that was produced, then it means that there is what? A closing unit. There is a what? A closing unit. How do we get the closing unit? The closing unit is the number of units. Please don't use the currency to do the subtraction. Don't come and less the 860,000 from this. You get it wrong. It's always the units before you multiply with what? The price. So for us to get our closing unit, we less the production unit, which is 100,000, from the sales unit, which is what? 81,000. Then we can have our closing unit. So our closing stock is equal to 100,000 minus 81,000 by the production cost per unit. By the production cost per unit. So 0.6. Because it is cost that we are calculating for, not sales. So you multiply. So when you subtract the 81,000 from the 100,000, you get 19,000. So 19,000, this is here you get 19,000. 19,000 by 8.6. And that is where you get 163,400. So we are lessing closing stock. We all know we less closing stock. So when we less our closing stock, we have 696600, and this is our cost of sales. Cost of sales. So when you get your cost of sales and the marginal costing, as soon as you get your cost of sales, look through the question. Do you have any variable expenses? If they are variable expenses, you add it to your cost of sales. So when we look at the question, we have variable selling and distribution. And the question said it is 10% of what? Sales. So we add variable selling and distribution. Let me make it very short. And they said it's 10% of sales. And what is our sales? This is our sales, not the sales unit. This is our sales. Our sales is 1,215,000. So 1,215,000. And when you find 10% of this, you will get 121,500. Now they said we should add. So we add our variable expenses to our cost of sales to get 818,100. So now we have our variable cost. One thing that you should know in accounting is when you less your variable cost from your sales, we get something called contribution. Contribution. So when we less the 818,100 from the 1,215,000, we will get, and that is our contribution. We get 396,900. Then we less our what? Fixed production overhead and our what? Our fixed non-production overhead. Our fixed non-production overhead. So what is our fixed non-production overhead? They are fixed over or fixed expenses. They are fixed expenses. So sorry, it is fixed non-production expenses. So these expenses are not incurred under production. They are incurred under selling and distribution. So we have selling. So the fixed production overhead is 112,000. Then we have fixed selling and distribution to be also 112,600. Then we have administrative, which is also fixed in the question, also as what? 110,000. So we add all here, then we move to this side, and you will get 334,600. When we less this, because you said we should less the fixed cost. So when we less this from our contribution, we will get 62,300. Sorry, I think I have to bring it here. So we will have 62,300, and that is our net profit for the marginal costing. That is our net profit for our margin. Let me write this net profit. So under the marginal costing technique, we had a net profit of 62,300. Now let's move to solve. So if you really understand this topic very well, this is very short and simple. You can just finish this in 20 minutes. Marginal costing, 20 minutes. Absorption costing, 20 minutes. So income statement for period 3 using absorption costing technique. Okay, so it's the same thing that we are going to do over here. So the same thing, we always start with our sales. And our sales unit was 81,000. by what? 15. And we had 1, 2, 1, 5, 0, 0. Then we less our cost of sales. This is the same format. Less our cost of sales. So there was no opening. There was no opening stock. So this one will be absorption cost of production. And we produced 100,000. So we are going to multiply this by what the production cost per unit. But then when we calculated for the production cost per unit under the absorption costing technique, we had what? 9.6. So another absorption costing technique, you're not going to use the 8.6 anymore. That is the only change that you see there. So we are going to use what? 9.6. So 9.6, because here the fixed production overhead is added over here. We are treating the fixed production overhead as a what? A product cost. So we multiply by this to get 9600. Okay. Then since there is no opening stock, the same amount to be our cost of goods available for sale, which is the Kroger's. Then, as I said, we less our closing stock. How do we get our closing stock? I hope you remember. We get our closing stock by multiplying the production units. Sorry, by lessing the sales units from the production unit. That is how we get our closing unit. So after getting your closing unit, then you multiply by the production cost per unit. So 100,000 minus 81,000 by what? 9.6. So when you do this, you get 182,400. And you get 777,600. And that is what we call the cost of sales. Good. So another absorption costing technique. When you get the cost of sales, we don't add variable expenses. Please note this. That is why I say it's just a format. And the format is saying that when we get to this point, we shouldn't add variable expenses. We should check the question if there is any under absorption or over absorption. So at this point, when under the absorption costing techniques, when you get to the cost of sales, you check whether there is under absorption or over absorption. When there is under absorption, you add to cost of sales. And when there is over absorption, you less from cost of sales. I hope this is clear and you understand what I'm saying. So with the under absorption, we always compare the budgeted and the actual to know whether there is under absorption or over absorption. So with this question, you are seeing that the budgeted is less 12,000 than the actual fixed overhead, which means there is what? There was what? Under absorption, which means there was what? Under absorption. That is it. So when you are very smart enough, you could see that the question is even telling you that the budgeted is less. The less should tell you that then it is what? Under. If the question is saying more, then it means it is what? Over. So since the question is saying the budgeted is less than the actual, then it means it is what? Under absorption. So you should know that anytime there is under absorption, anytime there is under absorption, there's another part that we also use to calculate whether there is under absorption or over absorption. That is when um, there is a difference in the production unit, that is the budgeted production units and the actual production unit. But with this one, they've already given you the amount and they are saying that the budgeted fixed overhead is less 12,000 than the actual fixed overhead. So we will say that it is what under absorption. And anytime you get to the cost of sales and there is under absorption, what we do is we add back. We add back. So since it is under absorption, we add under absorbed fixed overhead, which in the question they said it's what 12,000. So 12,000, when we add to this, we get 789,600. 789,600. Then we less from this. We less from this amount. So when we less from our sales, then we should add 10. Add 10, then we get 425400. Here there is nothing like contribution. Here we see it is gross profit. Contribution is when you less your variable cost from your selling price. So this is our gross profit. After getting our gross profit, we come and less our variable selling and distribution, which is 10% of what sales. And our sales is 1,215,000. And we will have 1,215,000. Then we have the fixed selling and distribution, which is also 1,126,600. Then we have our fixed administration, which is also 110. Then when we add these three figures, we have 344,100. So now we said we should less. So we are going to less this amount from the gross profit, and we will have 81,300. And that will be our net profit under the absorption cost 10 technique. Very, very simple. So these are the two techniques that we are talking about. So after doing these two, we have a way of checking if your answer is right. So normally, when you are asked to reconcile these net profits, you should get them right. If you are not getting the reconciliation right, then probably it could be that your answer that you've done, there is a mistake somewhere. So let's do the II. The II is saying that we should reconcile the statement, the two statements that we've done. We should reconcile it. And one thing that you should know is that one is also a format. So let me go through the format with you first. So with the format, with the reconciliation, you just want to reconcile the statements. So with the reconciliation of reconciliation, so the profits per the marginal costing. So let me put this city sign here. Let me put this city sign. So if you want to start with the profits that you had under the marginal costing, you add the closing, you add the closing fixed elements. What do you mean by the closing fixed element? What we mean by the closing fixed element is the closing units you have in your answer. The closing unit you have in the answer by the fixed cost per unit. So when you get to, so in this particular question, the fixed cost per unit for the fixed cost per unit or the fixed overhead per unit is what? 1. And the closing unit is what? 19,000. So for you to get the fixed closing fixed element, it is the closing unit by the fixed production cost per unit. So here it will be what? 19,000 by what? 1. Very simple. So this is just the format. Then you less, so sometimes some in the questions you have opening. So if there is opening, you less opening fixed elements. So if there is opening unit in the question, then you multiply the opening unit by the fixed cost per unit, which is what? 1. Or depending on the question, you less that one as well. So when you less, the answer that you get, you have to get the same profit per what? The absorption costing. Simple. So if you do your reconciliation and you're not getting the same as what you are getting, it means there is a mistake somewhere. Someone can also decide to start with the profits as per absorption costing. So with that one, if you want to start with that one, then it's the vice versa. Now, if you are starting with the profits as per absorption costing, you add what? The opening fixed element. Then you come and less the closing fixed element. Then you have to get the profit as per marginal costing. So anyhow or any way you want to do it, it should reconcile. It should reconcile. So let's move to this question and let's reconcile the two statements. So let's start with the marginal costing. Okay. So for the marginal costing, we had a profit of 62,300. We had 62,300. So profit as per marginal. And the format is saying that when we start with the marginal profit, we should add a closing what? Elements. Closing fixed elements. And the fixed cost per unit is what? 1 in the question. And the closing unit is what? 19,000. So we add 19,000 to this. So 19,000 to 62,300. And when you add this two, you should get this amount, which is 81,300. 81,300. So 81,000. You realize when you add it, you get it, and that would be the profit as per marginal, sorry, absorption costing. Very, very simple. So it's very, very simple. Very, very simple. I hope I was able to make this very clear and understanding for you. If you have any question, drop it in the comment section. I will attend to that. And if you really like this video and you enjoyed this video, like and put in the comment section. Don't forget to subscribe to the channel. Share for your friends to also have a benefit of this channel. You can also try using the profit as per absorption costing, starting with that one. And with this one, since there is no opening stock, so with this one, I did not bring any opening fixed element because in this particular question, we did not have any opening stock or opening unit. That is why when I was reconciling, there was no opening fixed element. So if you want to start with the absorption costing, you just have to less the closing fixed element and you get your profit as per marginal cost. Don't forget to subscribe and share for others to benefit from this channel. I'll be solving a different question in my next video where this time we are going to use the production unit and the budgeted unit to find the under and over absorption. So I'll encourage you to subscribe to the channel and click on the notification bell. When this new video is uploaded, you'll be the first to be notified. Bye bye. See you in my next video.